Last time we did one of these videos, it's actually been 2 months because we had a little bit of a break. Things were getting really stretched in both directions, and we were talking about very narrow breadth. There was some severe outperformance by semiconductors and memory and chip stocks. There was just like this little pocket that was just kind of going parabolic, and pretty much everything else was lagging. So I know that you referenced that most of the Mag 7 is lagging the S&P year to date at present. 2 months ago, they were all lagging the S&P, and some significantly. So there's been a little catch up for the large cap tech. And what caused that, or what sort of created that pivotal moment, was in fact a correction which has become pretty significant in those hottest stocks, the semis, the memory, and the chip makers. Those have all entered a severe correction, 20-25% off their highs, in some cases more. And what we've seen is that the market through yesterday was down, by the market I mean the S&P 500, it was down something like 2% from its recent highs. So there's been a lot of turbulence under the hood, but the market overall has held up phenomenally well. So if you're just invested in broad-based indices, you're perfectly happy. You may not even notice that there's been so much volatility for certain retail investors. I love the question because I am seeing a lot of charts and statistics going around about how the breadth improving, meaning more stocks are participating in, not that we've been rallying for the last couple of months, but more stocks are performing better than the very narrow percentage, through like April or May. There are mixed reviews on whether or not that's a good thing. I personally don't think there's any signal to it, to breadth being good and that being a good sign moving forward for the market. I actually sort of have a contrarian view on that. In fact, if the majority of stocks are trading, and you said 70% of stocks in the S&P are trading above their 200-day moving average, I don't know that I necessarily view that as a good thing. I think that is, it's a higher number of stocks that maybe can go down before they start to rally again. So I don't, my view, which is partly opinion, and I think we're going to probably back up some of this with some graphics and statistics that show it's really a mixed bag in terms of market breadth being a positive signal. I think that what we've seen the last couple months is a little bit of a shot across the bow for markets. I think it's we've had volatility sort of injected into the market, and it came at the expense of what was hottest for the first 4 or 5 months of the year. And I think we're maybe just going to probably have a slightly higher volatility regime for the next couple months through summer, which would not surprise me. I think as far as the Fed hiking in July, yes, I think that's off the table. I think it's we can comfortably say that. But to take it off the table for the Fed to hike again this year, or for the first time this year, I don't think that can be taken off the table. Like you pointed to the fact that these inflation readings are bumpy. Month over month, there's not a consistent theme. The only consistent theme is that we are still on a trailing 12-month basis above the Fed's projected target. I think it's still reasonable to assume that at least one hike between now and the end of the year, possibly two, is a possible outcome. And I don't, there are people, including us, data looked different a few months ago. We were sort of hoping that maybe we could enter a cutting cycle where, we start to lower the front end of the interest rate curve. And I just don't think that that's likely. And I think also, you made a reference, I'm sure there'll be another question about oil and energy prices and how large of an impact that plays on inflation. But oil has started going back up again. And I know that the news flow was like, the closure of the Strait of Hormuz doesn't matter. And for whatever reason, oil is just, pulling back to levels that we hadn't seen since before this war started. That's no longer the case. We're in a wait and see on inflation, and the Fed, I think, has to be sitting on its hands for a little while, but it wouldn't surprise me if 1 or 2 hikes before the end of the year becomes necessary. So the fact that interest rates, and we're referring to the 10-year Treasury, the fact that those interest rates are a little bit higher than they were a few months ago, I do not think that it signals the Fed is more likely to hike. Because I think if the bond market was anticipating the Fed hiking or hiking multiple times, there should be some optimism on the back end of the curve that those hikes would actually impact inflation, and potentially if the bond market was anticipating too many hikes or the Fed to do too much, then I think it would be anticipating a potential recession, which would be I think would have downward pressure on interest rates the back end of the curve. So we're not seeing that. So I think one way to sort of interpret what's happening, or what is the bond market telling us about expectations for the Fed, it's probably that they are not likely to hike or hike in an extreme fashion. To sort of summarize, to give a couple things that could go right. Of course, the Middle East is in the news all the time. We could have some positive development there about the talks that are ongoing. Something that's believable, something that feels like it actually does have long-term implications for maybe not peace, but just ratcheting down of the temperature and some certainty regarding the ability for oil and gas and fertilizer and other things that are required for the agriculture industry here in the United States to get through the Strait of Hormuz. I think that would be good for sentiment. Any kind of positive move on interest rates or something that could be done for affordability of homes. They kicked around the idea of doing a 40 or longer year, 40-year or longer mortgage. I think that could help. I don't know if they'll do it, but that could help. And of course, just a continued rotation under the hood of the broad indices, where maybe there's a continuing change of leadership, but the markets hold up okay. I do expect that the markets would be higher at the end of the year than they are now. But it would be interesting to see some different groups start to peek ahead. We are seeing some good performance from the banks. That's maybe something to feel optimistic about. Basically, I think if things don't escalate further in the Middle East, things don't get worse in terms of affordability for U.S. consumers, and the market continues to absorb the insider sales that we're seeing, which I don't think that needs to raise an eyebrow at all. Markets are high. That's when you're supposed to sell or lighten up a little bit, and these executives are paid a lot in stock, and it makes sense. So I think we're in a decent spot. Again, probably a bit more volatility for the next couple months, but rest of the year should be okay.